In 2020, Dave Portnoy made a $2 million bet on Bitcoin, and within days, he panicked and lost money. But here's the kicker. If he had used a simple strategy, he would have made over $3 million instead. This mistake is destroying your investments, whether in crypto, stocks, or real estate, and today we're going to show you how to never fall for it again. By the end of this video, you'll know exactly how to turn volatility into your best friend, the kind of friend that makes you into a millionaire. This strategy is called dollar cost averaging. It's a straightforward strategy where you invest a set amount of money into an asset at regular intervals, whether prices go up or go down. No guesswork, no stress, just steady investing. Instead of dumping your entire savings into Bitcoin all at once and hoping you picked the right moment, DCA spreads out your investment over time, averaging out the price you pay. This helps take emotion out of the equation, the biggest factor that trips up most investors. Say you bought Bitcoin at its all-time high in 2021, around $69,000. But if you had been DCAing $100 every week for the last 2 years, your average buy-in price would be much lower. In fact, you'd likely be in profit, even before Bitcoin jumped to the $100,000 price. That's the beauty of DCA. It smooths out the market's ups and downs and helps your investments grow steadily over time. A lot of people think they can outsmart the market by buying low and selling high, but even professional investors struggle to time things perfectly. Finance pros often live by the dollar cost averaging principle, and the ones that don't routinely get their faces ripped off by the market. Timing the market is like gambling in Vegas, except in Vegas, at least they give you free drinks. In crypto, all you get is despair and self-loathing. Just ask Portnoy. Okay, fine, but how do you actually do this? The best investors focus on long-term strategies instead of short-term gambling. You should too. Here's how. Number 1, pick your crypto. Bitcoin and Ethereum are solid choices for long-term investors. Number 2, decide how much to invest, whether it's $10, $50, or $100 a week. Just choose an amount that fits your budget. And number 3, set up automatic purchases. Most exchanges like Coinbase, Binance, and Kraken let you schedule recurring buys so that way you don't even have to think about it. And that's it. Once it's set up, you can sit back and let time do the work for you. Here's the crazy part. DCA isn't just a crypto strategy. The wealthiest investors in the world use it in stocks, real estate, and more. And it's made people millions, and you can do that too. DCA is one of the most reliable ways to put wealth in any market. Take Warren Buffett's favorite investment strategy, low-cost index funds. Instead of picking individual stocks and trying to time the market, he recommends consistently investing in something like the S&P. If you had started DCAing just $50 per week into an S&P 500 index fund 20 years ago, you'd have turned $52,000 of total investment into over $200,000 today without ever having to guess the right time to invest. Even real estate investors use a form of DCA. Instead of buying one property at what they hope is the bottom of the market, they consistently invest over time, buying rental properties in different market cycles, averaging out their costs, and building wealth without the stress of market timing. But what if I told you there's a way to 10x your returns? It's a strategy that turns market crashes into massive opportunities, and it's what the smartest investors do. DCA is powerful, but there's one final strategy that supercharges your returns. DCA plus strategic accumulation. Here's how it works. You DCA regularly, but when the market crashes, you increase your investment. Example, imagine you're investing $100 per week in Bitcoin, then a major market crash drops prices by 30 to 40%. Instead of panicking like everyone else, you double your investment temporarily, buying more at a discount. This is exactly what smart investors do in the stock market. When recessions hit, they increase their contributions instead of pulling out. Historically, every market crash has been followed by massive recoveries. The people who DCA and buy more in downturns, they build insane wealth, which you can do too. Combined with a few other smart strategies we're explaining on this channel, you can be as close to printing money as is legally allowed. So make sure to hit that subscribe button and leave your questions in the comments. We'll make videos specifically answering your questions.